So I'll give a quick introduction on Chris. So he's a managing director here at VIA, responsible for managing relationships with different funds, finding the best VC funds to invest in. He's actually the only LP we let into the class every year, and ever, I guess, just because he provides the most unique insights. He's been in the business for a very long time. He was heading up the TIFF, which is the investment fund for foundations, responsible for over $1 billion in capital commitments. He was also in the endowment team at not Stanford, but Princeton University, so managing that fund there. And one of the most interesting facts that I personally find about Chris is that he's known as the super LP. So there's some debate about where that term originated from. Some people say it's because he has super LP investing skills. Other people say it's just because he always wore a red shirt because he ran out of white shirts, so he started wearing red shirts. So it's like Superman. So
it's my super LP underoos.
So I'll let you judge what kind of idea the super LP came from. And he's only one of the few LPs who has a very well-known media and public presence, and he has a venture capital inspired blog called Super LP. So that's LP, what's the website for that?
Well, it's LP 2.0, but if you go to Super LP,
yeah.
it redirects.
And then he also recently launched an effort called Open LP, which maybe he can talk about later.
Awesome. Thank you so much. And it's great to have you guys here. I'm sorry if you're cramped or uncomfortable. We'll try to make you guys as comfortable as possible. But thank you guys for coming out. And when Ernestine called me, a while back, she said, could we come do a field visit? And I was like, sure. I don't know where everybody's going to sit, but I'm sure we can figure it out. And here we figured it out. So it's great to kind of talk to the class again. And I've really enjoyed the questions in the past from the class when I've done this before. And you guys look pretty darn smart. I hope that you pepper me with questions at the end. I'm told we have a stop at 2:30, so it's 1:45 right now. So we got 45 minutes. We'll save 5 minutes at the end for a tour, and then we'll maybe do like 10 or 15 minutes of questions. So I'll kind of run through, kind of where I exist in the ecosystem, and how I do the voodoo that I do. Let me tell you a story first about, I've got so many stories, but let me tell you first a story about how I became an LP. And for those of you who don't know, we're the money behind the money, right? So institutional investors, whether that's endowments, foundations, pension funds, you name it, there are all kinds of, insurance companies, others, are basically the kind of lifeblood of the venture capital industry. And one thing that's always been interesting to me is, funds go out and raise money, but often, one of the biggest pitfalls that kind of GPs run across is that, what they think they're competing against other funds, right? All they need to do is be the tallest midget, and this kind of, comports with the fact that, venture capital as an asset class has more units of ego per dollar of return than any other, right? And so, but what venture capitalists don't realize is that when they came and visited us at Princeton, now at TIFF and VIA, I've got dedicated funds that do only venture capital. But I then have to raise money from people who are kind of contextualizing venture capital within a portfolio. And so there's this question of, kind of as a portfolio manager, where do you kind of get the best risk-adjusted return? So that's something I hope to sensitize you guys to, because I think there's too much of an echo chamber where too many general partners I talk to, too many funds feel like they deserve money, when in fact there are ways that they need to articulate their message such that they can make their fund particularly interesting in the context of the entire panoply of assets available to all institutional investors. So speaking of institutional investors, so when I was at Princeton, I used to have a laugh because I went to Yale not once but twice for undergrad and business school, and then I ended up at Princeton, and all these managers would come in, these GPs would be doing the East Coast tour, and they'd go visit Harvard, and there's Peter Dolan, and he's a Harvard guy, and they'd go to the Yale Investments office, and everybody went to Yale. I couldn't get a job in the Yale Investments office, maybe that says something. But then they'd come to Princeton, they'd say, hey, are you guys Princeton alums? And we didn't have any on the team. And so I'd always say, well, I went to Yale not once but twice, so I'm behind enemy lines. But as they said in Roman times, ubi panis, ibi patria, where there is bread, there is my country, and Princeton's got a lot of bread. And, and so that would get kind of, loosen it up. But kind of even going back before that, it's always interesting to hear kind of why people become what they become and kind of their own journeys. And this is something I spend a lot of time on. And in fact, I just did a session for the Kauffman Fellows called part of it was called the personal journey, and understanding, kind of how people find their highest and best use. And I'd always been a tinkerer. I was a strategy consultant before business school, and then before I went to business school, I was at a strategy consulting firm called Monitor Company, which was Michael Porter's shop. Do you guys still read Michael Porter in strategy class? Pretty much like 5 Forces, all that stuff. Okay. So it was Mike Porter's shop, and Mike was awesome, but he was like this ghostly figure. Nobody ever saw Mike, right? And so it's my last week, and my office mate was this woman she was amazing. She was crazy smart, and especially in the context of all the diversity stuff that's going on today, it was interesting because she had been head of the Harvard Womanist House, right? So it wasn't the women's house; it was the Womanist House, WOMYN, because they were not woe men; they were women. And so Jody was awesome because she was always like, we should have co-ed bathrooms, right? So this is very topical, but this is going back to 1998. We should have co-ed bathrooms, right? Because there's so much networking that goes on in the men's room. Now, how many of you have actually ever networked in a bathroom? I certainly haven't. But anyhow, so it's the last week, and I'm taking Jody out she's going off back to Harvard Law School, and I'm taking her to lunch. And on the way to lunch, we stop at the bathroom. She goes in the ladies' room, I go in the men's room, and there's Michael Porter. I'd never seen Michael Porter except for like the kind of welcome speech he had given when we all started. I'd never seen him before. And he's at the urinal, so I walk over next to him, and I'm standing there, and I'm like, hey, Mike, you still playing a lot of golf? Because he'd been an All-American in golf at Princeton. He goes, oh, no, not playing very much. I'd love to, but I don't have time. And I say, hey, by the way, I'm going off to business school. What is it that I should be thinking about? He said, railroads. I go, railroads? He goes, yeah, this is 1999. He goes, it's 1999. All my students, they want to go into technology, they want to go into investment banking, they want to be in consulting. Nobody wants to go into railroads. He goes, a guy like you, pretend to be smart, quasi-charismatic. He's like, you could be CEO of Burlington Northern in 10 to 12 years, and watch, Warren Buffett will buy that company. And it turns out Warren Buffett did. I didn't go into railroads, I went into investing. But like a buffoon, I don't listen very well. But anyhow, so we're jibber-jabbering. I thought it was actually good advice. And we're walking out of the bathroom, and as we walk out of the bathroom, Jody's standing there. She sees me walk out with Mike Porter, and Mike just goes out of nowhere. He goes, hey, you should call my assistant. We can go golfing this weekend. I'll invite you out to the country club. And Jody just goes, oh, you see? I told you all this networking that goes on. Needless to say, not only did I never call Mike and we never played golf, I didn't even listen to his advice. So that shows you how dense I am. But the story actually does have a point, which is then I went back to Yale for business school, and I spent my business school summer doing investment banking at Morgan Stanley and was totally miserable. And my lesson from that was that I wanted to be the principal, not the agent, right? And I was talking to my friend Seth Alexander, who's now the CIO at MIT, and Seth had been in the Yale Investments office at that time, and he goes, I said, what's the secret to Yale's success? And he gave me a bunch of things that were actually all very interesting, which are for another time. But he said, one of the things is we're blessed with a weak benchmark, right? He said most LPs kind of don't know what they're doing. They fall into all these cognitive biases. They tend to be crowd following. They're career risk averse, all this stuff. So he's like, as a result, if you do anything creative, you can actually be awesome almost by default. And I heard the echo of Mike Porter saying railroads in that moment, and I decided I needed to get in the investments business, in the endowment management business. I asked him if there was any jobs at Yale. He said, for you, no. But I'll invite you I'll introduce you to the Princeton guys, and the rest, I went to Princeton, had an awesome time. So that's kind of my origin story, and here we are 15 years later. So let me tell you a little bit about the voodoo that we do. Investors, people in my seat wear a lot of hats. So I made this list in 2009, actually. First in 2001, then in 2009. Like, what do we do? I gave this speech to the Philadelphia Venture Capital Association, all 3 members. And I said, here's what we do. We're high throughput screeners, we're professional skeptics, investigative journalists, blah, blah, blah. And in 2009, I said, look, we're whipping boys in our institutions. We're referees, kind of refereeing fights between LPs and GPs, therapists. We actually do a lot of stuff that's interesting. I was just talking to Matt. I care about Matt, right? Matt is a partner of mine, and I want him to be happy and fulfilled. And I was talking to him about, like, is he happy? Like, what is it that he needs to kind of flourish as a person, not just as a venture capitalist? And so that's something that I spend a lot of my time doing. So it makes me kind of a professional amateur psychologist, if that's not oxymoronic. But here's what it feels like today. People keep asking me, like, what's the environment like? And this is what it feels like. So those of you might recall the movie The Great Gatsby, and there's Nick Carraway, right? And Nick is like the hanger-on, like he's been invited by and I picked this quote from Fitzgerald from another book called My Lost City. And this actually reminds me a lot of Silicon Valley today. And as an LP, there's a party going on around us, and we're like Nick, kind of watching the party unfold around us with kind of bemusement and dismay and concern. And I love this quote: "The tempo of the city had changed sharply. The uncertainties of 1920 were drowned in a steady golden roar, and many of our friends had grown wealthy. But the restlessness of Palo Alto in 2015 approached hysteria. The parties were bigger, the shows were broader, the buildings were taller, the morals were looser, and the liquor was cheaper." I love this kind of generalization of boom times, and it feels like we're in boom times. And one thing I think about over the story arc of my career, and Ernestine told me that some of you guys are maybe thinking about raising funds, or you guys will do different things in the entrepreneurial ecosystem. I like to invest in small funds, and we'll talk a little bit about that later. And I'm writing a blog post right now that I'm going to publish. I'm doing a talk at TechCrunch Disrupt on Monday, and I want to publish it before that, but I don't know if I'll get it written. And the post is called "The Opposite of a Good Time." And I remember, and I was thinking about it, it was such a good time to invest in 2005, 2006. You could not miss, right? It was this amazing moment, and that's when I backed Josh Koppelman in first round, and Mike Maples in Floodgate, and all these amazing folks, because my challenge at TIFF was to invest heroically. That's what our chief investment officer asked me to do, invest heroically. And I'm like, whoa, what an amazing thing. So long story short, it was such a good time. And I actually went back, and I was talking to Josh Koppelman at first round this morning. I said, how many funds were there in 2006? And we actually counted them off. There were like 17, 18 funds, right? That were doing, kind of what today is called micro VC. Today, there are 325. Isn't that amazing? How many of those, so each of those funds does X number of deals a year. So how many companies are getting funded? Which means, like, how many people who should be entrepreneurs or should be employees are now entrepreneurs, right? There's this kind of propagation throughout the entrepreneurial ecosystem that results of kind of too much money kind of being out there. And it's, as a result, there's this huge party. I mean, it feels really dismaying. So, talking quickly about the voodoo that we do, we as institutions, we think about two things. Where do we play and how do we play? And with respect to where we play, you guys all know portfolio theory 101. When you have two assets that are uncorrelated, you actually get a better outcome because of the diversification benefit. But what most investors really do, they're so motivated by career risk. And the last slide basically said, quoted Lord Keynes saying, it's better for the reputation to fail conventionally than to succeed unconventionally, right? And as a result, what do people do? Well, they follow. Who do they follow? Well, they follow the Yale guys, because the Yale guys, I don't know if you guys just saw, Yale reported a 93% IRR on their venture portfolio over its history, which goes back to 1985. Like, that is amazing, right? And everybody wants to replicate that, but not everybody's Yale. Not everybody has the same relationships. Not everybody has the same. But basically, there's a bunch of people out there trying to copy Yale. In fact, when I used to pitch TIF's funds to small nonprofits, I'd walk in the room with these investment committees, and everybody would have a copy of Swenson's book. And I'd sit down, and I'd open the book, and I'd say, "Now for a reading from the Book of David. Please turn to page 282." And people, kind of literally open it up. I'm like, "No, I'm just kidding. I'm kidding." So people ask me, used to ask me, like, what's the average allocation to private equity, which includes venture capital, among institutions? And I said, well, it's probably, at the time I said, it's probably 20%. Why? Because Yale's was 20%. Now it's up to 31, which is amazing. But not everybody can do that. So So it's interesting, the kind of, if you guys learn anything at Stanford, I'm told it's a fine school. It's a very fine school where there's amazing people. You learn so much from your professors and your colleagues. For those of you who go into any kind of financial related business, the thing that you should be most aware of, that you should take away, is always to understand the principal agent problem, right? People will act for their own benefit, and that's not always aligned with what makes sense for you. And especially, investing in private equity investing in particular is rife with the principal agent problem. We can talk about that later. But one of the kind of drivers of the principal agent problem is people in my seat typically tend to care more about their career than they do about generating excess returns. There are very few people who actually try to invest heroically. Now the flip side of that is fools rush in where angels fear to tread, but so far it's worked. This is maybe one or two more philosophical thoughts. For those of you thinking about venture capital, this is actually Princeton's asset allocation. So for those of you who've taken, studied modern portfolio theory with, Bill Sharp's a Stanford guy, here's expected return and here's risk as measured by standard deviation, which I could teach a whole class about why that's a misspecification of risk. But if you look at it, here's our kind of panoply of assets and what we expected the return to be and what we expected the risk to be. I used to, in the Princeton board books every year when I prepared this, because I was kind of the model jockey, I'd put some things out here that were high risk, low return. Like one year I put baseball cards in here. One year I put rare coins. And every year, somebody on the board was like, Douvos, at it again. Anyhow, so you can see VC is the riskiest and highest return asset that most investors will invest in, right? It is literally the longest dated, furthest out of the money option that we buy, which makes it a very, very, very uncomfortable place for institutions to invest. So I always talk about this. These guys are the patron saints of VC. Does anybody know who these guys are? They're awesome, right? This is Curtis Sharp and Lou Eisenberg. They're the first lottery winners in New York, the first big $5 million lottery winners. And the reason I put these guys up is, in venture capital, investing in venture capital, we use lottery slogans with Ivy League veneer. So when we say things like optionality with a straight face, what we really mean is, hey, you got to be in it to win it, right? When we talk about asymmetric payoff, you're talking about, you're using another lottery slogan. Hey, you never know, right? Dream big, right? This is, venture capital is the bodega where people in my seat, are buying the lottery ticket to maybe try to get that discontinuous asymmetric outcome. Look, I even say it unselfconsciously. Anyhow, you guys know this stuff. Venture capital, is a great place to be right, but if you're wrong, it stinks. And then most LPs end up sitting around saying, "Where's the beef?" Because there's such skewness in the asset class that even being top quartile actually typically doesn't beat the public markets. And that's a really big problem for the industry and something not a lot of people talk about, and it's really scary. Actually, I'll pause here. Let me pause there for a second. I've been talking like a madman. Does anybody have any questions?
I'll ask a quick question. I guess you talked briefly in the beginning as the role of an LP, and you're kind of just, the Great Gatsby analogy is perfect. I love it when you share that. Can you talk a little bit in terms of looking at the VC firms out there right now? How do you decide on which ones to invest in? How do you think about continuing to support funds that you've already supported versus supporting new funds?
You're awesome, because this is my slide. So, and you didn't even see it because the glitter's bad. Everybody's got a different way that they think about funds. And this, for those of you who can't see it, it's a 4-pillar process. And at the top, you've got people and strategy, and they're kind of related. So I spend most of my time trying to understand the people. And what is it that makes them distinctive? What makes them unique? Matt Acco is a really interesting venture capitalist because he has an amazing breadth and depth of knowledge, and nobody works as hard as him tirelessly to build networks and community around the goal of helping his portfolio companies do better, right? So he's an amazing kind of force of nature. But that alone, isn't enough. You got to pick a strategy that makes sense for you, right? So I don't pretend to have wisdom as to whether or not, nanotech is the new thing, or augmented reality or virtual reality or robotics. I don't know, right? I believe that these things, are interesting, but I don't pick the segments per se. Rather, what I do is I try to make sure that the people are doing something that's interesting. People are choosing something that is resonant with their skill sets, right? So an example is, all of a sudden now, people who are investing in consumer-facing apps are now robotics experts, right? How does that happen? It's pretty amazing. It's amazing how unself-aware a lot of venture capitalists are. So checking for that resonance. Out of the people in the strategy falls the portfolio. That's the people in the strategy in action, and that's where I spend a lot of my time understanding the portfolio and spending time with portfolio companies. So on an average day, I try to talk to at least one portfolio company and try to get to at least one portfolio company in person. I can't always do that, but it's a lot of fun when I can, because entrepreneurs love to talk about their business, and it's a way that I can get one step closer and actually almost disintermediate the GP as a prism in my information flow, right? That's the true primary source. And then out of the portfolio falls the performance, which I believe is a lagging indicator, not a leading indicator. Now, one of the challenges is a lot of people in my seat look at performance as the be all and end all, right? And this is where you start to get in trouble. And to your very thoughtful question about how do you decide to stay with somebody, a lot of people. When I was talking to Josh this morning, we were talking about First Round 2, right, which is a 2008 vintage fund and has Uber in it, right? And that fund is crushing it along all dimensions, right? Except that they haven't gotten liquid in Uber. And so, when that happens, if it happens at the magnitude that we think it'll happen, it'll be one of the best venture capital funds ever. But until that happens, until the moolah is in the kula, right? There's, you can't, somebody said something to me today, and I wrote it down and put it in my pocket and lost it. It said, it's a bad day when you come to the conclusion that you're unrealized in terms of the unrealized portfolio, that you're unrealized is unrealizable. And it happens a lot, right? Like the gap between, between NAV and distributions isn't always, is sometimes there's a lot of slippage between cup and lip.
And then I guess, has your strategy and thoughts changed nowadays, especially since there's so many billion-dollar valuations, unicorns, a lot of questions on whether or not we'll actually see exits and profits from that?
Yeah, so has my strategy changed? My strategy has not changed, but I will say that I tend to invest in managers that will tend to be structurally underweight unicorns. And what I mean by that is I tend to like managers that tend to invest in very tangible stories, right? That are really focused on metrics, are really focused on path to profitability, unit economics, things like that. And if you look at a lot of the unicorns, a lot of them were momentum plays. Now, it sounds like I'm saying this, kind of dancing on the grave, and 5 years ago I was, kind of begging to get into unicorns. If you ask me why I won't be successful, like if we were to sit here 10 years from now and I could postulate why perhaps I hadn't been successful, it's that I have this like real skepticism about momentum. And so as a result, the managers that I choose are not momentum managers. So I had so many fewer unicorns than some people in my seat. And it made me look bad, right? And what's crazy about venture capital is like left, a bubble that goes long enough, you'll get a bunch of these things actually liquid, right? And that's what's, Twitter I don't think is ever gonna be, a very profitable company. And the stock's at all-time lows and this and that. But a lot of people made a lot of money on Twitter. I had no Twitter exposure. And it's all, I wouldn't say that's by design, I wish I had Twitter, but it's all kind of part of a piece, and my managers would be structurally biased against companies like Twitter. that makes sense.
Yep. And then what's your view on markups in terms of, we were actually just speaking with Matt Ocko the other day, and he was lamenting that, oh, I have maybe a $3 million investment that's making $100 million in revenue, and the company hasn't been marked up by other VCs, hence it's not really a metric in an LP's portfolio.
So, this is an interesting question, going back to that slide, where standard deviation or volatility becomes a proxy for risk. The prices are so stale in venture capital that kind of stuff happens all the time. Now, I love Matt madly, but every one of his companies is either doing $100 million or going to be doing $100 million imminently, and that's what I love about him. I love that kind of optimism and excitement, and he's been very, very good at finding companies like that. The thing I'll say is that's what makes it really hard for people like me, particularly because most LPs meet a fund that they invest in within 6 months of actually making the investment, right? And now if you think about it, the average venture fund lasts 10 years, right? The investment period is 6 years, 4 years, 5 years, usually shorter, but contractually it's 4 to 5 years. And then you have another kind of 5 to 6 years of kind of harvesting period or growth period, and then a harvesting period beyond that, so that's when you have extensions. So the life of a fund actually tends to be 10 years plus 4 or 5 1-year extensions. So that 14-year fund lasts twice as long as the average American marriage. Isn't that crazy? So what I would say is, marry in haste and repent at leisure. And so I got a call today from a very, very good venture capital firm that's having a close in June. And I said, I can't invest in your fund because I can't get to know you that well in that time. And so that kind of depth and length of diligence that's part of my personal tradecraft is really important for me to understand the longitudinal growth of these companies. So I'm not really focused on the markups, because when you do meet companies in this heat of the fundraising moment, the portfolios are all marked up. There's actually some academic studies talking about how GPs artificially mark up their portfolios and then mark them down after. So everything's marked up. You got the bullshit detector, the spidey sense is tingling like crazy. It's anxiety inducing, right? And so that's why by getting to know these companies, I knew Josh Koppelman for 2.5 years before I invested in first round back in 2006. I knew Matt for 3 years before I invested in DCVC. And understanding kind of the arc of their companies is this portfolio box, and that's where I put the most stock. So that's a long answer. I hope that's helpful. Any other questions?
How do you see the venture capital out of the US?
So this is not a popular answer. I almost got thrown off the stage at Kauffman a couple of weeks ago. But I'm going to try to be constructive about it. I'm an ecosystem investor. I believe, and I've actually done some work with the City of London's kind of Tech City UK, where they're trying to build an ecosystem. And I think that for a startup to succeed, you need money, which is a total commodity. You can get money anywhere. You need momentum, right? And all you need is a couple of companies to kind of have great momentum. You need entrepreneurial management, and you need mentorship. And by entrepreneurial management, you need those people that can take a company, from, just beyond product market fit through $50 million in revenue, the fast-growing hyper growth, right? And those kinds of people actually don't exist in a lot of places in the world, right? And then you need mentors. If you look around, my neighbors, when I used to live over on Channing, one of my neighbors had been the founder of Redback Networks, and all he did all day long was mentor portfolio companies, right? Because he liked doing it. Bill Campbell, right? Rest in peace. Bill was amazing. He was just a guy, and all he did was mentor people. Rajiv Motwani, who used to teach at Stanford, same thing. I spent a lot of time. You contrast that, and I'll whip London for a moment, just because I know well. In London, what happens is autonomy gets bought for $6 billion, and everybody moves to the south of France, right? The whole ecosystem, it's like Kaiser Sose, right? And so now, does that mean? And so here's where I'm going to try to get constructive. I believe that all those elements need to exist in one spot. However, I also believe that there are clusters of interesting industries. So, for instance, very few of those things exist in Minneapolis, But there's great medical device innovation in Minneapolis, right? This is cluster theory, like Mike Porter again. Like, why is Milan the hotspot of women's shoes, or men's shoes too? Like, because you've got all this talent there, right? And you've got these kind of things that spin off. So maybe you see Minneapolis or Research Triangle Park or Seattle in certain ways, and similarly you could see Berlin and what's the new? There's a new like city in the UK that everybody's excited about in Europe.
Berlin.
Well, Berlin, but there's another one that like Berlin is so 2013. Like it's so somebody's telling me Berlin is over. It's all about whatever now. I forget. I've given up on following it. But there are these
Estonia.
clusters. What's that? Estonia is always hot, right? But like Israel, right? Israel's got some great clusters and some very specific things. So I don't think that there won't be great companies, but in terms of kind of systemically producing great companies, so that's actually a very different calculus. Like, you can be a venture capitalist and find great things, but I, as an investor in venture capital funds, and have to pull back the aperture a little bit more and say, is this an ecosystem that will produce enough? I'm glad for you to take career risk, but I don't know if that ecosystem risk, and there's an asymmetry where it's like probably not a great risk-adjusted return for me, but it could be for a GP. Does that answer the question?
Yep. So I guess a quick follow-up on that. So that's kind of the perspective of a GP, a VC firm investing internationally. What are your thoughts in terms of there's a lot of international capital available for individuals in Silicon Valley, maybe raising VC funds, trying to get access to Silicon Valley, a lot of new wealth that's being generated in what were previously developing countries.
So this is capital looking for investment opportunities here. Mm-hmm. So if you go on my desk, you'll see business cards from people in the Gulf, in China. It's amazing how many people are kind of coming here right now. And it stresses me out because it means that there's like, I spend my life like waiting for the marginal dollar to get washed out of the system, right? Because there's more beer for us, right? Like, the marginal dollar sets the price. And like, I've just been lamenting, like one of my slides that I usually go through, you saw with the hedge funds and I'm like, oh my gosh, like Fidelity and T. Rowe and Valiant and Tiger and all these guys were like ruining pricing, right, in Silicon Valley, right? Like, they're setting this tempo, this crazy tempo, and like I was relieved when they were like washing out. And, Fidelity's not really investing much, and some of that, Tiger's been going overseas, and they've been replaced by all these like new participants who are just as glad to mark up everybody's portfolio companies. And I'm like, look, the return on any asset is a function of the price you pay and the capital you consume. And the prices you're paying are being driven up by these outside dollars, and that's what stresses me out. So to your second question, which is, if I were a GP raising a fund looking to outside capital, there's two questions I'd ask. And I laugh because I think about how Madoff raised a lot of money from Russia. And you guys know, like, everything went haywire on Friday, and then people were supposed to be told that they weren't going to get their money on Monday. And on Saturday, the CFO of Madoff had his door kicked in by two Russians with machine guns. And said, "We get our money now." And so that's like, that's always, it's non-trivial. That's actually a risk. But what I would tell people is that that venture capital, and this is another important thing. If you take anything away from this talk, one is think about the principal agent problem and kind of career risk and people's motivations and incentives and how they impact their investing. And two is venture capital is a multi-period interaction, right? A lot of people, like people always ask me about New York versus Silicon Valley, and I always think of New York as a transactional environment. LA, I think, is this way too. And what I mean by that is people are always looking to get an advantage in the interaction at hand. And they can kind of move on to the next thing and not worry about repercussions. There's an ethos in Silicon Valley, which I think is one of its great strengths, of multi-periodicity. The person that somebody said this great phrase to me once. They said, in Silicon Valley, you're never going up or down, you're just always coming around, right? And I think that's a very powerful thing. So the question I'd ask is, if I were raising a fund and taking money from outside, is, am I going to be investing in something that's sustainable? Am I going to be doing something where kind of, am I just trying to hit some seam that may or may not work and then my idea is blown up? Or am I giving myself an opportunity to build something of lasting value that'll be mutually beneficial for me and my partners? Is that helpful?
To follow up on your talk about like Fidelity and T. Rowe and these large institutional investors, what are your thoughts on like their valuation markups and markdowns? Like in the past couple months, they've marked down significantly and then marked it back up, and how that's impacting how VCs value the companies and like the money flowing in.
It's a great question. All questions are great questions. Fidelity's been really public with their markups and markdowns. And first round is an investor in Blue Apron. And Blue Apron is also a Fidelity portfolio company. And I've been watching the Fidelity markups and markdowns, right? Like they marked it down 12%, they marked it up 36%, they marked it down. And then I talked to the board member from first round, Finn Barnes, about the numbers, and he obviously says this all in great confidence, but the numbers are like this, right? Now, that's the, Caterpillar's numbers may be like this, but their stock goes like that based on the market. I think it's really bizarre that Fidelity's markups and markdowns are a thing to venture capitalists, right? Because the idea of the private market is that you have a respite from the mania of the public market and the animal spirits, right? Like it's like another asset class, timber, right? Like if prices are bad, you leave the trees in the ground and the trees keep growing. And by the way, not only do they keep growing, but they become harder. They turn from softwoods to hardwoods. So there's actually step functions in terms of their value, right? But you don't care about the market price. And I think it's obscene that Fidelity, kind of comes in and then has to publicize this stuff. It's like against the idea of a kind of a private market. Now the flip side of that is there are a lot of companies that are private that Fidelity invests in that should be public, right? And that's a whole nother question. Like the emerging growth, segment of the public market has been eviscerated, and there are like 18 reasons for that, which are a whole nother class. But as a result, like I look at my portfolio and like the mature end of my, like in our flagship fund, I have a mature manager, and their portfolio looks like the S&P Midcap 400, right? Like the median valuation of a company in the S&P Midcap is like $3.5 billion. I think there are like 30 startups within like a mile of here that have that valuation, right? I mean, it's crazy. It's probably not 30, it's probably 15, but certainly you go up to San Francisco, it's probably 30 up there. And these are like mid-cap companies. Like, why are they not public? And by the way, so did any of you guys read my my blog post about the exit sphincter? Read it. Basically, like there's a flow, right? Like we as LPs give money to VCs, VCs invest in companies, companies then exit, send money back to the VCs who send money back to me, allowing me to give money to my VCs, right? This is the circle of life. And what happens is we're feeding the snake and nothing's coming out the back end. We've got a tight exit sphincter. And so the snake's just getting bloated and constipated, right? I did this talk at the NVCA annual meeting, and Dixon Dahl was sitting up in the front row with his coat and tie. And I taught, has anybody heard the Wu-Tang Clan song Method Man? Yes, thank you. There's this like thing, they're talking about how they might torture an enemy, and they go, I'm going to I'm going to sew your butthole shut. I didn't say butthole. I'm going to sew your butthole shut. I'm going to keep feeding you and feeding you and feeding you. And that's what it's like to be an LP, right? Like we're there's all this capital going in and it's not coming back out. So the circle is interrupted. And yeah, so if Fidelity wants to be a constructive participant in the market, what they should do is should hammer on regulators to make the public market more inclusive. Yeah, that's my soapbox rant.
On your relationship with Matt and all of that, you say you take a couple of years to get to know them. How do you manage the expectations that you may or may not fund them or invest in them? And what kind of conversations or what goes on?
It's a really tough balance, right? Because I used to say at Princeton, it's harder to get into our portfolio than it is to get in our college. And we could fill our college class 10 times over with people who would be, competent. So, so very long story short, I try to be as explicit as I can be with folks about, my getting to know them process. And I say, look, this is not this is not an investment, I'm not an investment manager. I'm not an investment manager like others who focus on all quantitative stuff, right? Because I don't have the luxury of investing in tangible assets. I invest in people. So one question I ask people is, tell me about your best self. What is your best self? Like, what is your aspirational self? Tell me what you're doing to get to that aspirational self. I asked a question the other day. It was actually really, really powerful for me. I asked a woman who's raising a fund, I said, tell me, personal growth comes from, and we're learning organisms, right? Personal growth comes from times of difficulty or discomfort. Tell me about some discomfort that you've experienced that has impacted the way you invest today, and how are you putting this into practice? And she actually talked about her time selling enterprise software in the 90s and the harassment, like the appalling stuff that people would do to her because she was a woman, and what that did in terms of kind of creating a veneer, and kind of impacting her, her kind of investment style. It was really powerful because during that discussion, she started crying. And it was this really kind of poignant moment of great vulnerability. And it was so profound, and I was like, wow, this is somebody, like, we'd completely pierced the bullshit. And this is somebody who was like actually talking about how they had some great success in really learning something. And so few venture capitalists are open to learning new things. And when I'm investing in somebody for a 14-year cycle, I want to make sure they can learn. I don't know how we got to that answer, but it was something somehow. Any more questions?
Can you talk about the explosion of seed funds and what you think that's doing to the market and how you view that as an LP?
And do I attribute it to the market?
How you view that impacting the market?
Yeah.
And then just from an LP's perspective.
So, so like I said, I'm working on this blog post called "The Opposite of a Good Time." It's just crazy, right? And now anybody with an idea and a bunch of friends who made money at Facebook can raise a fund and be in business and play pretend venture capitalist, right? And it's really short-term bad, long-term good. It's short-term bad because every deal is just more competitive. I was talking to Josh Koppelman about this a while back, and the First Round guys actually published this thing about a year ago, like reflections on the first 10 years of First Round. And Josh talked about how pricing in the seed stage had gone up by a factor of 3. So all else being equal, a 10x fund now becomes a 3 and a third x fund, right? You've totally slashed the multiple with no corresponding reduction in risk, all because there's all these marginal dollars. And by the way, I meet with all these folks, and I'm like over it. I actually figured out I've met with like 180 sub $100 million funds in the last 12 months, since Jan 1, 2015, 2016, yeah. So whatever that is, 16 months, whatever it is. I'm over it, like it's exhausting. And what I tell some of these people is, I say, and by the way, if you leave the 30-mile radius around here, if you go to Cleveland and you pitch like your post-seed whatever strategy, they don't know what post-seed means. It's like flavors of snow, right? There's all these like differentiations that don't differentiate. And so my buddy Samir Kaji at First Republic did this great report. We found something like 65% of all seed funds have either 0 or 1 institutional investor, right? Like it's a huge number, which suggests to me that they're very, very fragile, right? Like the slightest hiccup that may not even be their fault, they're going to go away. Why is it a good thing? It's a good thing because I think the good entrepreneurs see how useless some of these tourist, proto VCs are, and the VCs that actually add value, right, and can be thoughtful and diligent, like Matt, like the First Round guys, like the True guys, others, like the Andreessen guys, they become that much. It throws into relief how much more valuable they can become. But I'll tell you the most sinister thing, and here's my other bit of wisdom. I just go around collecting wisdom and then regurgitating it at the right time. Mr. McCants at Greylock, Henry McCants, one of the founders, and I call him Mr. McCants the way Derek Jeter calls Joe Torre Mr. Torre. Mr. McCants said to me once in 2001, he said, Douvos, when venture capital is working really well, capital is very expensive and time is cheap. What happened during the bubble is that time got very expensive and capital got very cheap. And I see that, there's a deal, I'll tell you guys, like for us and whoever's watching, on video eventually, there's this deal that another fund I know did. And I was meeting with the CEO. It's a company here in town. They have $1 billion valuation now. And I said, oh my gosh, you guys are like the perfect data collective company. Did you guys go talk to Matt Acco and Zach Bogue? And this guy said to me, he goes, yeah, we did, and we love those guys. They were so energetic, and they seemed like they had a lot to offer our company. But Matt said, before they invested, they had to meet with these three data collective. Part of what they do is they have these great industry resources that they bring to bear in both due diligence and company improvement stuff. And so they said, you got to meet with like the CTO of this company and this, and they'll help us evaluate and vet your company. And it'll take a couple of weeks. And then this company walked into multi-billion-dollar Sand Hill Road venture capital firm office, and at the end of the first meeting had a term sheet. How do you compete with that? And by the way, back to this like marry in haste and repent at leisure question, right? Like for some people, and there's this tempo that's being set both by these small funds and also by Andreessen Horowitz that's fouled up the whole industry, right, in a way. And first round, one great metric is they said from the minute they met a deal, when they first started, from the minute they met a deal till they invested in 2005 was 101 days. Today it's 51 days, right? That stresses me out. Any more questions?
Can you also talk a little bit about the challenges for a VC raising a first versus a second versus a third fund?
Yeah. So VCs raising, a lot of people ask me, how do I get my first fund off the ground? And the long story short on that is I tell people it's kind of think of it as a 3-step process, almost like an FDA clinical trial, right? So your first fund, basically you have to make sure that it doesn't kill anybody, right? So this is like a phase 1 trial. So a lot of people like Manu Kumar at K9 has done a great job of, his first fund was $7 million and he found some interesting things and kind of had great proof of concept. So phase 1 trial, check. Then you raise your second fund, which is kind of a, call it $25 to $35 million, where that's the, the phase 2, the efficacy trial. Does this thing like really work? You haven't killed anybody. Now does it really work? And then the third fund is really where you have the, that's the big clinical trial. That's where you can really raise, more money in a kind of substantial way that can, you can start to pursue some really interesting things. So I encourage people, unless you've got something like really outstanding, or if you have some kind of a connection to a sovereign wealth fund and can raise $100 million out of the box or whatever, for people kind of striking that out on their own and planting a flag, that kind of multi-period, multi-fund vision is important. And for all you guys, like as you think about, I don't want to sound like preachy and like an old person, but I'm feeling older by the day. One thing I always tell people to think about, I talk to all the time. VCs ask me like, what should we do? And I say, look, I feel like Yoda. Begin at the end, you must, right? Like, start at the end. Like, where do you want to be? Where do you want to end up? Like, what is it that is your, like Aristotle talks about eudaimonia, which is like this high state of like self-actualization and self-realization. Like, what is your eudaimonia state? And then work backwards from there, right? And for some people that means raising a fund. For some people that means raising a $25 million fund. For others it means raising a $3 billion fund, right? It's a different thing. It's like, what do you want to do? What do you want to be happy? Live by your own definition of victory, not somebody else's. Wow, that sounded all like preachy. Maybe one more question, then we'll take a quick loop around and then take off.
What do you think in terms of the current state of fundraising for VC firms, in which I guess in the past it might be every 5 years in which a VC raises a fund. Now it's become a lot shorter. Like some VCs will raise a fund every 2 years, 3 years. What are your thoughts on that?
So there's a lot of stress in the system as a result, because LP's whole model is built around being able to stomach the difference between a 5-year fundraising cycle and a 7-year liquidity cycle, right? Now liquidity cycles are longer and fundraising cycles are shorter. So now you might have to invest in 3 or 4 funds that are coming back every 2 years before you even see what Fund 1 has accomplished. And then by the way, by the time you figure that out, then Fund 5, Fund 1 might have been a $50 million fund. Fund 5 might be, a $6 billion fund, and it's a completely different thing, right? And the performance is less indicative. But what's interesting that's happening that I'm sure you guys have talked about is in venture capital, what we're seeing is a real barbelling, right? So every quarter I look at the top 5 firms, they end up raising anywhere from 60 to 80% of the dollars in a given quarter. So there's this immense kind of bulge bracketing of the venture capital industry. At the same time, you have this kind of Cambrian explosion of these small funds, which I think is kind of sort of quasi-healthy, but too many things are getting funded and whatever. And then there's this immense gap in the middle, right? I think there's a real gap in the A and B round to kind of fund some of the interesting stuff that's going on. So I think as a result of this kind of barbelling, it's actually becoming a slightly treacherous time to be an entrepreneur, because you need to figure out how to build your business in if you can get that early funding, which should be easier. It's then harder to build your business in a sustainable way, because you either have to just turn the growth dial like crazy so that you'll get attention from some of these quote unquote bulge bracket firms, or you try to build your company at a steady pace and hope that one of the few remaining A-round players will fund you. And I think that's a really tricky thing. When I talk to entrepreneurs, I really stress out about the amount of financing risk that's endemic now in the business, because these big funds have so come to dominate the landscape. I just got all stressed out.
You mentioned a little bit about the top quartile funds being responsible for pretty much all the venture returns in the industry. What do you recommend to folks like ourselves who are interested in VC and want to get into VC? How do we screen ourselves so that we select to the actual funds that are outperforming the S&P versus everyone else, the vast majority who's underperforming? It seems like there's all kinds of VC funds out there.
Right.
Essentially, how do you recommend for us to screen for the ones that are actually successful and doing a good job?
And then I guess also related to that note is you mentioned very, very early on that you like to invest in smaller funds.
Yeah.
And obviously the returns for smaller funds are a lot easier than if you're trying to get a $3 billion, a return for your $3 billion fund.
Right. Yeah, the arithmetic works a lot better for small funds. And I used to go through this example, like if you have a $500 million fund, to generate a 3x gross, which translates into usually mid-2s for me, which is kind of the minimum I should expect from good venture. To get that 3x, that $500 million fund has to generate $1.5 billion of enterprise value to its ownership. And if you own 10% of a company at exit, that means you're creating you have to be invested in companies that create $15 billion in enterprise value. That's a lot, right? Like, that's a lot. That's, putting aside the kind of 5 or 10 kind of companies of the decade each decade, it's really hard to do, right? You're not going to do it by $300 million exits, which, by the way, are very good exits, whereas small funds can get there, right? And so kind of to your question, when I say what I'm looking for, if you ask me what I'm looking for today, I'll say I'm looking, I don't believe in the Midas list, right? In Fortune, I think it's fraught with methodological problems. But let's use it as a metaphor, right, for the best venture capitalists. I'm not investing in the Midas list of today, because that shows me what people did 5-7 years ago, right? I want to be investing in the people who are on the Midas list in 2022, 2025, right? And so I'm trying to shoot that arrow over the horizon, right? And so kind of directly to your question, if you're figuring out who the best funds are of today, there's actually a chance that there's a lot of debate about it. Do winners repeat and all that stuff. What you're doing is you're joining a partnership, right? You're joining a family. And so what I'd say about that is, like, make sure the family's right? And if the family's right and healthy, at some level, there's brand value, and it's better to be, a Rothschild than a whatever. So I would say if you had a chance to join a place like Sequoia, that's a no-brainer. But at the end of the day, the venture capitalists that I see that are most kind of fulfilled and happy and are most aligned for success are those that have a well-functioning partnership where they have freedom, right? And this is another thing that I've kind of learned over time. The 2 greatest luxuries in life are, 1, being able to set your own agenda, and 2, being able to choose the people you work with. And if you can get those 2 together, and I think kind of a corollary to that is finding people who are intellectual peers that push you to make your best thinking. And if you can find people that you enjoy working with that push you to your best thinking in non-sinister ways, that's the definition of victory right there. Thank you. Thank you very much.